Today, let's talk about development financing, and I'll be breaking this presentation into two parts. One is for construction and the other one for takeout financing, also known as term debts. On this presentation slides, I have included the most popular 5 financing programs that are currently available to investors. And what I want to do today is to make some comparisons between these programs side by side, comparing apples to apples, so you get to see which program works for what situation, and overall which program is the best suited for your project. So let's start with construction loans. Out of these 5 columns, the first program being non-CMHC standard, which has been around for a very long time and likely the most well-known to investors. Under this program, for the construction piece, the loan to cost is 75%. On the second column, you're seeing non-CMHC Select, which is relatively a new program introduced by CMHC in 2022. The loan to cost under this program is 95%. And both the standard and the select are MLI products, mortgage loan insurance products. So that means CMHC is going to be the insurance provider, and the funding source will still come from a CMHC approved lender. So you're dealing with 2 entities here. The third option, CMHC ACLP, Apartment Construction Loan Program, formerly known as RCFI, will give you up to 100% of the cost. And unlike the MI products, under this ACLP RCFI program, CMHC is going to be the direct lender. The fourth option, conventional financing, means financial institutions are funding the loan using their capital, and for the construction part, usually they fund up to 80% of the cost. With the last option of private financing, the deals are usually funded by private lenders, usually mortgage investment corporations or mutual fund trusts, up to 85% of the cost. Now, what you are seeing on the screen are policies. When you have an actual project, your numbers will very likely change depending on the merits of the project itself. And what I want to do next is to go a little bit deeper in the underwriting side of things, so you get to see what the lender's concerns are and how they will determine what loan to value they can offer to you and if they can fund your project at all. So there are 3 considerations for a construction lender when they look at a construction loan application. Number 1 is actually the net operating income, which is the most critical metric because the net operating income determines the total feasibility of the project. And the lower the net operating income, lower the mortgage amount, because the term debt has to be debt serviced at 1.1 minimum, which we'll elaborate on later. Now, a few things I want to mention to you to help you increase the success rate of getting financing, particularly when you're developing in secondary and tertiary markets, because I noticed that's becoming more and more common these days. The challenge with developing in secondary or tertiary markets is that data available, the data you already have on hand, might not be so reliable. And sometimes there might be no data available at all. And when I say data, I mean rental rates, vacancy, supply competition, etc. For example, if you're one of the very first few apartment developments in a small town, and there are tons of land available for developments, and the city is also pro-development, now what will happen to your building, your business, once other developers come to build more apartments? With the new supply competition, will your vacancy rate go up? And can you sustain the current rental rates you're charging? The lenders will want to understand these things and what your strategies are if that situation ever happens. So what do you need to do for getting the financing is to, number 1, reflect these considerations on your pro forma, and number 2, prepare the mitigation strategies when you're doing your initial feasibility study if this is a brand new development. And for the construction loan itself, one of the first few questions the lender will ask you is, what is the takeout plan? Are you planning on getting a CMHC takeout with a 40-year, 50-year amortization, or is it going to be a conventional takeout where the amortization it's only 25 to 30 years? And generally speaking, the longer the amortization, the lower the payments. So on the same amount of net operating income and the same debt coverage ratio requirement, the loan amount will become higher on the extended amortization. And the third loan determinant factor is the debt coverage ratios. The calculation of debt coverage ratios is using net operating income divided by mortgage payments. I notice a lot of developers want to use the MI Select program these days because this program offers very high leverage. But from the deals we have worked on, if the net operating income can only support, let's say, 75% loan to value in today's interest rate market, then 75% loan to value is all you are going to get. Although on paper, you can get up to 95% loan to value. It's like buying houses. If my yearly income is 20,000 and I can only qualify for 150,000 for the mortgage, then $150,000 mortgage is all I can get. It doesn't matter if I buy a property of 500,000 or if I want to buy a property of 2 million. $150,000 mortgage is all I can get because that's all my yearly income can afford me to get. Now, let's talk about construction interest rate. In today's market, as of February 27th, 2024, the term debt interest rate will be different, which we'll talk about later. Under the MI products, currently interest rates are about prime minus 50 to prime minus 75, so right around 6.5 to 6.7. Under the ACLP RCFI program, the interest rate is based on the GOC rate in today's market. The GOC rate is about 3.5. On the screen, you notice that I also included a 1% buffer because the GOC rate can change during your ACLP application. And the effective interest rate, the interest rate that's actually applicable to you, is going to be the GOC rate on the funding date. So I'm being very conservative here and added a 1% interest rate buffer. And on the conventional programs, the interest rate is about prime plus 85 to prime plus 175 bips, which gives you 8 and 9% for the interest rate in today's market. And with private construction financing programs, the interest rate is about prime plus 250 bips, so right around 10%. Now, for the construction loan terms, under the MI products, we're seeing up to 2 years for the construction loan. The ACLP RCFI will give you a 10-year term, a 10-year time frame for you to construct, lease up, and stabilize. This 10-year term is also part of the 50-year amortization. With bank and private lenders, we're seeing up to 3 years in terms for you to construct and stabilize, also for you to have a really strong net operating income to take out with the institutional lender. Fees with MI products are straightforward. It's on the application fee per door basis. So you do have to pay a lender fee to the lender because under these two MI products, MI Standard, MI Select, CMHC is going to be the insurer, giving you the certificate of insurance, and then you still have to engage a lender to provide the funding, and therefore you need to pay a lender fee. The bigger the loan amount, the smaller the lender fee in most cases. ACLP, RCFI, under this program, you need to pay an application fee as well, but you don't have to pay a lender fee because in this case, CMHC is the direct lender. And under conventional financing, you will pay a lender fee to the lender in the range of 50 to 75 bips. And under private financing programs, you need to pay 100 to 250 bips. Insurance premium. So you only need to pay insurance premium if you are getting the MILI products. The more CMHC requirements you can meet, the cheaper the insurance premiums will be. I have a separate video dedicated to help you understand the MI Select program and how its scoring system works, and make sure to check out that video. I have included a link here. Amortization. MI Standard will give you up to 40 years amortization, and MI Select and ACLP will give you 50-year amortization. And conventional lenders, private lenders usually will offer you up to 30-year amortization. Personal guarantee during the construction phase. So during the construction phase, all the loans from all these 5 sources need to be 100% personally guaranteed because the lender wants you to stand firmly behind your projects and make sure construction will progress to completion. But the loan amount that needs to be personally guaranteed can be reduced once the building is stabilized. And we'll talk more about that later on in this presentation. Now, we're done with construction and we're ready for stabilization. So it's time for us to get a term loan. And as you can see, we now only have 3 columns, 3 options. The ACLP RCFI program is now gone, and so is private. Because the ACLP program gives you 10 years to construct to stabilize, so you don't need a separate takeout loan. Private options are also removed because private lending is more suitable for short-term use. So once you have a income-producing property, it's more beneficial for you to get CMHC financing or conventional financing because CMHC and conventional options are cheaper and more for long-term use. And on these three programs, MI Standard will give you up to 85% loan to value, and MI Select will get you up to 95% loan to value, and bank financing usually up to 75 to 80%, so up to 80%. Interest rates on the CMHC MLI products, your pricing will be right around Canadian mortgage bond plus 50 bips. So as of today, February 27th, 2024, CMB 5 years is about 3.8, and the CMB 10 years is about 3.9. So it depends on if you want to take a 5-year term or take a 10-year term, your pricing will be right around 4.3 to 4.4. With conventional bank financing, the interest rate will be GOC plus 200 bips, so right around 5.5 in today's market. Terms. All these programs will give you up to 10 years for the mortgage term. The CMHC programs we're seeing are mostly 5 years or 10 years. Bank financing, we're seeing 5 years, 7 years, and some financial institutions will offer you 10 years as well. And what about the fees? So with the CMHC programs, very similar to construction, if you just want to get a term loan, you will have to pay an application fee based on the numbers of the units. Your insurance premium will be determined based on how many scores you have, and lender processing fee if you're just getting a new lender for the takeout. And if the term loan is converted or rolled over from the construction loan, then there's no need to pay these fees. With conventional financing, lenders will also charge a lender fee in the range of 10 to 15 bips. And amortization-wise, MI Standard will give you 40-year amortization. MI Select will give you 50-year amortization, and with bank financing, it's usually 30 years. And personal guarantee. So earlier we spoke about this. During the construction stage, 100% of the loan needs to be personally guaranteed. But once the building is 12 months into its stabilized operation, you can negotiate to get a loan down to 40% of the loan amount that needs to be personally guaranteed. So you only have to personally guarantee 40% of the loan amount once the building is stabilized. And if your loan to value is less than 65%, you can even negotiate to have a non-recourse loan, and that will be very attractive. And similarly, with conventional financing, lenders will consider partial recourse as well. To what percentage of the loan, we'll have to look at the deal on its own merits. Debt coverage requirements. So for the CMHC MI Standard, for the residential component, you need the debt service at 1.2, and for the non-residential component, you need the debt service at 1.4. So if you're doing a mixed-use project, we'll underwrite the commercial component separately and combine it with the residential piece at the end. And for the CMHC MI Select program, debt coverage ratio for residential component is 1.1 and 1.4 for the non-residential. And for conventional financing, debt coverage ratio for the residential component is 1.1 to 1.25 and a 1.2 plus for non-residential piece. Now you have most of the information about the financing options. So how do you decide which loan program is the best suited for your project? Well, here are a few key considerations to help you make up your mind. Ask yourself these questions. Is the speed of funding the most important thing for this project? Then consider conventional or private options, because CMHC was taking about 6 months just to issue the certificate of insurance in 2023. Now it's better, but it's not significantly better, the timeline-wise. And if you want to be the first one to finish construction and to lease up the units before your competitors do, then time is of the essence. You do have to prioritize the speed of funding. Alternatively, is the highest leverage the most important thing for this project? If that's the case, then consider CMHC options. As you can tell from the previous slides we went through, CMHC does offer very attractive leverage. And also, is a lower total financing cost the most important thing for this project? If that's the case, then consider conventional financing, because that way you don't have to pay CMHC insurance premiums and it's less fees than private options. Last but definitely not least, I want to share with you what the lenders are thinking when they look at the loan application. Number one, which is the most important thing, they want to understand the project's feasibility. What is the ideal unit mix? What square footage are these units? And how much projected rents can you get? Who are your clients, the renters? What's the profile of these people? What are the projected expenses? Because your business plan will determine the projected net operating income, which ultimately is going to be the most important metric to determine your financing options. And for the construction loan itself, make sure to underwrite everything from A to Z, to all the way to the term to the takeout financing. Because I can't emphasize this enough, all lenders will underwrite everything from the back to the front. So they underwrite the term loan first. You have to figure out what term loan options will be realistically achievable for a project. And of course, if you need help, our firm can assist you on the financing part of your project from day one at a very early stage before you even buy land, and we can lay out a very clear roadmap for the financing. Number three, borrower's financial strength. How much skin in the game do you have or can you bring to the table? Besides what you already inject into the project, will you have access to capital? Because what if there's a construction delay and cost overrun? How can you manage that? The lenders want to see you have liquidity to push the projects to completion. Basically, that's what they're looking for. Lastly, your experience developing and managing similar assets. I'm seeing a trend of townhome developers getting into the apartment business these days, but the issue these developers will be facing is that although they did really well with townhomes, they have little or no experience with building apartments. If that's the case, what you can do is you can have a really good builder, really good GC construction manager who's well-versed in the apartment construction business, get into a fixed price contract with them and leverage their experience. Similarly, if you haven't owned any apartments in the past, now you want to get into owning apartments, you need to engage a reputable property manager because CMHC also has very clear requirements on the management's experience managing apartments. If you don't have the experience, you need to have the team in place for you. Lastly, if you're looking for assistance with your project financing, we would love to work with you. Our brokerage, Pulsar Enterprises, is a mortgage brokerage in Mississauga, Ontario, and we focus on commercial financing, particularly apartment financing. And I'm the principal broker of this brokerage, and below is my contact information. Reach out to us at an early stage. We will help you find the financing options and create a roadmap that ultimately leads to a success result. Thank you for being with me through this presentation. I hope to connect with you soon.